bonds by increasing prices. Inflation that is built in happens when workers push for pay raises in response to rising prices. A feedback effect can result from this kind of inflation, with businesses constantly increasing prices to cover the rising cost of labor. Increasing consumer costs can have far-reaching consequences for economies on a national and international scale. Generalized price increases reduce the purchasing power of the average person. Individuals' diminished purchasing power dampens economic expansion because fewer goods are bought. A wage price spiral can occur when workers seek more excellent pay due to widespread fear that high inflation will remain. Governments take policy measures to rein in price increases. Knowing how inflation and the government's usual response affect the economy is crucial for making money amid inflation. In modern times, governments often manage inflation by raising the minimum interest rate, the rate at which banks and credit unions can lend money to one another without collateralization. Increasing interest rates harm the economy because borrowing money becomes less appealing. Similarly, as the interest rate on savings rises, it appears to be a better choice to save money rather than invest it. However, if interest rates are raised too quickly, a bear market, recession, and increased unemployment could result. Employment and interest rates move in tandem. Slowing economic growth. Increasing interest rates reduce consumer spending and company investment because borrowing money becomes more expensive. Businesses and consumers have cut their spending as a direct effect. Increasing unemployment. Unemployment rises as rates rise because of decreased demand and fewer available workers as a result of the higher production costs. Is making money during inflation something you're interested in? While inflation in and of itself is significant, the broader effect it has on the economy, such as rising interest rates, unemployment, and public opinion, are what matter when assessing which assets will soar and which will fall. Traditional inflation-proof investments include real estate, vehicles, commodities, and equipment, bonds, sector-specific stocks, and unexpectedly, cash. In the times following interest rate hikes, which are often characterized by slower economic growth, tangible assets and intangible assets whose value is connected to real assets are seen to perform well. To either keep up with inflation, generate passive income, or profit from a future bull market, some people may choose to invest in the following ways. Number 1. DeFi Savings App, a new way to make money during inflation. Compared to more risky options like Bitcoin and stock investments, the returns from decentralized finance, DeFi, can be stable between 3% and 8% annualized. Get high-yield savings in a DeFi savings app that protects your savings up to $100,000 per user, $250,000 for Gelt Concierge, and keeps your money indisputably in your hands by using non-custodial technology. Deposits and withdrawals are free in US dollars. Number 2. A high-yield savings account. The benefits of cash during inflationary periods. Currently, the annual percentage yield, or APY, of high-yield savings accounts with a conventional financial institution is 1%. While you won't earn any interest on your money with this type of account amid inflation, you'll have the option to retain some funds available in case the economy slows down due to interest rate hikes. Number 3. The property is an ever-reliable inflation hedge. Investment property is a tried and reliable way to make money during inflation, as it can provide a regular income. Due to the correlation between inflation and home price increases, property ownership is often seen as a means of protecting one's wealth. As the loan-to-value ratio decreases as the value of the home rises, you end up effectively making fixed-rate mortgage payments on a home worth more than what you originally borrowed to buy it. If housing values go up, landlords must raise their rates to cover the increased costs. Number 4. Can you make money with stocks during inflation? Equities, or stocks, have a track record of outpacing inflation. Around 10% per year is the average return of the S&P 500 index, which is more than the U.S. inflation rate of 2% in 2022, the highest level in 40 years. Trading stock at times of high inflation carries the risk of volatility, especially in the short term. For instance, the first and second quarters of 2022 saw negative returns on the S&P 500 that were double digits. Seeking a short-term stock market profit amid an inflationary period? Take into account the variety of stock available. In times of rising prices, dividend stocks typically underperform, while companies that pass price rises on to customers or whose value is tied to commodities do well. Number 5. Commodities perform well during inflation. Gas, cotton, soybeans, wheat, oil, and copper are all examples of tangible goods that often outperform and gain value under inflation. Material costs tend to rise in tandem with increasing demand for manufactured goods. Since the cost of commodities and other specific resources tends to react more quickly to economic movements, a rise in commodity prices alone can indicate future inflation. Inflationary periods and the lead-up are standard times for seasoned traders to engage in commodities futures trading. Keep in mind that commodity indexes typically perform poorly. Number 6. A safeguard against inflation, gold has been long admired. Gold, as a commodity, is often seen as a hedge against or even a source of profit during times of inflation. Potential buyers of gold must think about more than just the purchasing price. However, they must also consider storage options, price volatility, and opportunity cost. Stocks and treasuries could provide a more reliable means of profiting from inflation. Gold exchange-traded funds, or ETFs, are a form of exchange-traded fund designed to track the price of gold bullion. Note that these two types of ETF are taxed differently. And number 7. Bonds in times of rising prices. An investor's purchasing power may be preserved through bond holdings. U.S. savings bonds are meant to keep pace with inflation, but may not generate a profit during periods of high inflation. Bonds have traditionally served as a hedge against volatility, but speculative assets have a far higher correlation between declining. Plan how you will make money during this period of rising prices. Being outstanding at anything is the best strategy for surviving inflation, according to Warren Buffett during the Berkshire Hathaway 2022 shareholders meeting. Inflationary periods are inevitable, along with the interest rate hikes and economic slowdowns they often cause. The most effective way to make money during inflationary periods entails a two-pronged approach. Consider your immediate and long-term financial needs when budgeting. Don't make dramatic changes based on current inflation and market conditions, since most of us are still long-term investors, says Diahan Lassis, a CFP and managing principal of PPAC Private Wealth Management. Now, you can make passive income in many ways. To know more, subscribe to the channel, and I will come up with a more exciting and informative topic in the following video. That's it for today, folks, and I hope you liked the video. Subscribe to the channel and ring the bell icon for the latest updates.